Hi, I am Joe Halpern, Chief Investment Officer of Fountainhead. Welcome to Investment Wars. At Fountainhead, we regularly incorporate debate into our analytical process. On this podcast, we seek to have meaningful, respectful conversations on major themes within the economy and markets. Will globalization end? Will China pass the US in overall GDP? Will robots take over the world? This is our effort to better understand the nuance and complexities of financial markets. Today's guest is Paul Musson. Paul Musson was a senior portfolio manager at McKinsey Investments. He also owned a pub and recently wrote a book called Capital Offence, which we're going to talk about today. I found Capital Offence to be really thought-provoking, challenges how the financial system currently works and offers some fixes. For novices, it's really digestible. It discusses how money works. It lays out some fundamentals of economics and finance in plain language. And then for the more advanced reader, it's packed with strong contrarian takes and clear arguments that force us to really think differently. So it's a really nice book. Paul, welcome to the show.
Well, thanks, Joe. Great to be here.
So, Paul, in the book, you cover a lot of ground. Again, recommend people to get it. It's a nice read. We're going to focus on three areas here. We're going to focus on interest rates, bailouts, and then we'll touch on some of your ideas for solutions, in terms of some of the problems you kind of highlight. So in terms of rates, I want to give some background. In America, you go out and there's a mortgage rate for your house, and that mortgage rate is based on interest rates, and it really works off what I'll call where the Fed sets interest rates, and then there's some sort of premium on top of that, and then you could kind of go there with nuances based on characteristics. You kind of define two types of interest rates, a natural rate of interest and a neutral rate of interest. Could you define those for the listeners?
Yeah, sure. Thanks, Joe. Okay, so a natural interest rate is just that. It's naturally determined by market forces, by people with their own skin in the game, their own hard-earned capital, and they are making risk-return decisions with their capital. Likewise, the people who are borrowing the capital are also making risk-return decisions and with their own skin in the game. And when you have millions of people making these decisions, making these assessments, you end up with what is a market-determined natural rate of interest. Now, importantly, this natural rate is what leads to the most or the optimal allocation of capital. It leads to the most productive economy. Capital is being allocated most productively. And so this interest rate, whether it's higher or lower, will be determined by what's called the time preference of savers. So if you have money and you have a high time preference, that means that you want to consume more today and save less. You want to do things today. Time is more important to you. If you have a low time preference, then you will save more and consume less today. Now, if you save more today, it means that you can consume more in the future and more over time. And so the higher the time preference of a society, which means people want to consume more than they save, then there are less savings available for borrowers, and so the natural interest rate should go up. Now, it doesn't go up and down a lot, but that's typically how the natural rate will move around. And if you don't interfere with that rate, it leads to the most productive economy. The great economist Ludwig von Mises said that policymakers can deny you the right to receive the natural rate of interest, but they cannot eliminate its existence, which now leads me to what the neutral rate is. So the neutral rate of interest is really about debt-fueled consumption. And so policymakers will encourage people to take on debt to consume. And one of the reasons they do this is that because they believe that consumption is key to economic prosperity. It's not. It's saving and investment, which then leads to consumption. That is key. But they decide this because they'll look at GDP and they'll see that 2/3 of it, roughly, and GDP is all final spending, they'll see that 2/3 is consumption. So they think, because my consumption ends up being somebody else's income, it's important for me to keep consuming. But I can't keep consuming unless I've saved and invested and have created capital to then have the wherewithal to keep consuming. So anyways, so when you have,
So what is the neutral rate? Like what is the definition of the neutral rate?
So the neutral rate, thank you. So the neutral rate is the rate of interest that allows for debt-fueled consumption and steady growth in the economy without resulting in inflation.
Okay, so neutral rate, a little bit. The first one more. So I want to kind of go back. So the natural rate, that feels like your kind of economics 101. There's supply demand.
Yeah.
Some people out there, right? The demand is for money. The supply is the money. And they meet at some equilibrium. And that's that famous line where you have like supply, demand, and in the middle. And then what happens is if you artificially change one of those lines, again, kind of economics 101, you have, inequality, inelasticity, and all these other kind of, I'll call them characteristics, which makes like, okay, if you increase the supply of the supply of money, conceptually it lowers the amount, and that might create a lot more borrowers than you should actually have. Is that, and potentially.
Potentially, yeah. It gets complex, but let me try to put it another way. So because policymakers encourage debt-fueled consumption, and you see debt levels going up all over the world, sovereign debt, consumer debt, household debt, whatever, that when you take on so much debt, you eventually run up against a ceiling in terms of how much you can spend because you can't service any more debt. And so when policymakers see that happening, that people can't service any more debt, what they do is they lower the interest rate. So in their mind, the neutral rate that keeps spending going without causing inflation has gone down, but it's gone down because people have so much debt. And so they lower the interest rate, the neutral rate. People then able to service more debt because the interest costs are lower. Economic activity picks up. Policymakers are happy. But eventually, people have taken on so much debt, they can't service that debt at the new lower rate. So they have to lower rates down even lower. And so policymakers believe that the neutral rate of interest has been grinding lower and lower for decades. And in fact, it has. But it's not because of demographics. It's not because of secular global stagnation, as one of the excuses they use. It's because the world is awash with debt. And they have encouraged this sort of behavior. And now they're stuck.
Got you. Okay, that's helpful. Yes, I got you. So natural rate is what should naturally occur between borrowers and lenders. And then the neutral rate at this point is somewhere below that, just based on where we kind of are as a society and this belief that, I guess it's two beliefs, just that debt is actually a promoter of growth, which is questionable. And then the second one, which is, well, in order to allow this to continue, we have to make sure that interest coverage, the amount you have to pay every year to fund your debt, remains artificially low. And that's one of a number of arguments in the book of like kind of going down this path. And this, by the way, is timely. I keep on reading articles. So one of them here in the U.S., we just passed the Big Beautiful Bill. The Big Beautiful Bill, just cutting through what whether your positive tax is going lower, higher, social structures, all that stuff. At the end of the day, the math is that the CBO, which is the government office, the Congressional Budget Office, states that the deficit as a percent of the GDP, and the GDP is a measurement used to say what is the output of this country, is going to be around 5.5%. In 2026 and 2027. That's an estimate. It's hard to get it right, but let's just assume it's exactly right. If that's the case, that will be among the highest deficits in the last 120 years. The only time that the deficit on the budget deficit has been higher was World War II, the great financial crisis, and COVID. That's it. And supposedly, I believe we're in peace. And the belief is that the economy is doing well. So kind of going to your point of some deficit fuel spending, we'll be talking a touch about it in our commentary coming up. So I want to get another definition from you, because I think it's important just to kind of go down the road of just kind of analyzing this a bit. Money supply. Talk to me, I want to bring money supply into this because that's something that kind of affects inflation and therefore it affects interest rates. Is the idea conceptually that a healthy economy has money supply flat or growing, ideally in line with GDP growth and population growth? Is that economically sound?
Well, it depends on what school of economic thought you lean towards. Now, I lean toward the school of economic thought that says the money supply does not need to increase with population growth or with growth in the economy. I think it was the great British classical economist David Ricardo who said that the correct amount of money in the system is whatever it is at this moment. Just don't ever change it, higher or lower. Now, Milton Friedman believed, I think, that the money supply should increase at a predetermined rate, 3% or 5%. I think he changed his mind a couple of times. And that wouldn't be so bad. But, of course, the money supply has grown at a much faster rate than that over the last 50 years, particularly once the U.S. went off the gold standard. Nixon took the U.S. off the gold standard in 1971. But there are empirical evidence that you don't need the money supply to increase. So in the last 30 years in the U.S., in the last 30 years of the 1800s, you had significant economic growth in the U.S., and the money supply hardly budged. And so what you had is what should be the natural outcome of a free market economy with a stable money supply, in that the more productive the economy becomes, the more stuff that's being produced, and you have a stable money supply, then the prices of all that stuff should necessarily fall. And it's called good deflation. And so we should be having falling prices of 2%, 3% per year. And the beauty of that is even if you're on a stable wage, so your wages don't go up every year, but in real terms, you're becoming wealthier every year because you're benefiting from the productive capacity of the economy. And one of the reasons this happens is because if you have free competition, anytime a company or an industry starts producing excess profitability, it attracts competition from others. Others start investing into that industry to participate in this excess profitability. What it does, it forces prices down for consumers. And so we're all supposed to benefit from this. But this is not good for those who hold a lot of debt, because the debt contract is fixed. The amount that you owe does not go down. And this is one of the reasons that governments have been at pains to convince people for decades that inflation, a little bit of inflation, is necessary for an economy to grow. Nothing could be further from the truth.
Yeah, it should be the other way around. right?
Yeah, no, exactly.
Yeah.
And why shouldn't we all be benefiting from the productivity enhancements that are going on and the free competition? And it was happening in the last 30 years of the 1800s in the States. But central banks will tell you that not only is good deflation, or they don't call it good deflation, they call it deflation, is bad for the economy. They will tell you even zero. So even flat prices is not good for the economy. They will tell you that we need 2%. And
Right.
it was just sort of arbitrarily chosen years ago.
Well, you got to choose something. But I think the 2%, like the 2%'s really a function of aiming for 2% growth. And therefore, it's attached to, okay, if there's 2% growth, then I guess there's 2% inflation. But I kind of want to unpack what you said a second ago, just to make sure. And you used in your book a lot, which I think is good, an island economy, because it makes it small and much easier to understand. And so here the idea is if a company creates COGS and they're doing a good business on selling those COGS, in one way you think, okay, well, we could just raise the prices of those COGS. But the reality is that because this company is doing a good job selling COGS and making money on COGS, others will come in. And that's that capitalist ethos of competition without any artificiality, which should actually necessarily drive down the price of COGS because there will be people will find efficiencies, et cetera. Did I get that right?
It's exactly right. So when competition comes in, they'll drop their prices. Yeah. And so that forces the incumbent now to invest in their business to be able to make those COGS at an even cheaper rate, be more efficient. So think of flat screen TVs. Back in 2000, they were like $3,000 or something like that. And today, they're a few $100 and they're way cheaper. And they would be even cheaper than they are today if the money supply hadn't grown at such a high rate over the last 25 years.
Got you. So outside of money supply, though, there are other areas that can result in inflation. So if you think about COVID, post-COVID, and we're going to kind of get to a COVID example later on in the conversation, but one element of it was the government came in, they increased the money supply dramatically because they felt like COVID was deflationary. We'll get to that part soon. Another item that happened during COVID were supply shocks, right? The whole global system kind of broke down, and there was a level of inflation there where there was just, I'll call it scarcity, right? And that's another way that you could kind of get to inflation beyond just simple money supply. So aren't there like just a number of ways to kind of get to an inflationary or deflationary kind of scenario without money supply changes?
So it depends on your definition of inflation. So the standard definition is a sustained increase of the prices of all goods. And a sustained increase in the prices of all goods can only happen in two ways. A, the money supply grows faster than the amount of goods being produced in the economy. Or B, the amount of goods being produced consistently falls. And if you have a stable money supply, rising money supply, then you'll have inflation. And I give one example in the book, again, the island economy, where if you had like a barter system, there's a few people on the island. One collects coconuts, so another collects water, another collects fish. So 1 liter of water is the price of one coconut, it's the price of one fish. And so they're all exchanging at these prices. But then there's a supply shock in the coconut industry. So Jill, or whatever, she hurts her ankle, she can't collect as many coconuts. So then now there are fewer coconuts. Now the price is, so there's a supply shock in coconuts. So now the price of coconuts has gone up in terms of fish and water. So now it's 2 fish for one coconut, and it's 2 liters of water for one coconut. But the prices of coconuts and or prices of water and fish has gone down in terms of coconuts. So now it's only half a coconut for one fish and half a coconut for 1 liter of water, right? If you can only have inflation once 2 things happen in an economy. First, you have to introduce money. And second, the money supply has to grow faster than the amount of stuff being produced, or the amount of stuff being produced has to be contracting perpetually.
Right. I mean, in the island economy, I guess you could try to find one item like water. Everybody needs water, and water could just go up in price relative to all those other items you're bartering with. And I guess the word I wanted to grab on that you said is sustained. And I think it's really important because inflation is measured on an annual basis. And so even taking your example of 2 coconuts, one coconut for 2 fish instead of 1 coconut for 1 fish, if all of a sudden it became 1 coconut for 2 fish, so the inflation of coconuts is 100% that year. But then if I forgot the woman who sprained her ankle, whatever her name was, Jill, there we go. Not really relevant, but trying to. Yeah. So if Jill's ankle was permanently injured, which would just be a shame for our fictitious Jill, the price would remain stable at 2 fish for a coconut. So year 1, you'd have inflation jump 100%, but after that, it actually would be flat. So that correct. Sustained element, I think, is really important where you have a change because, right, inflation you could have, again, post-COVID, you had some inflation that everybody hoped was temporary, and it doesn't necessarily increase after that, meaning, something occurs.
Like tariffs, right? Like tariffs should not lead to inflation. It should lead to a one-time price hike, assuming all the foreign companies don't absorb the tariff. And one other thing I would mention, Joe, about during COVID and the supply shock, the government shut down the economy. And then they mailed people what they call stimulus checks. So why are you trying to stimulate an economy that you just shut down? And as a matter of fact, imports into the ports of California in 2021, when inflation started taking off, imports of loaded containers were hitting all-time records. So you had, 100 ships out in the ocean waiting to come into these ports, not because the supply chain was broken, is that more goods were going through that supply chain than ever before because people have been mailed these checks to go out and spend. So it was extremely high consumer spending that caused that inflation. Now, it's not to say that there weren't supply issues, particularly in things like semiconductors for cars, and there were definitely issues in some parts of the economy. But I don't believe that supply chain issues were the main cause. It was an explosion in the amount of money that was in the system.
Okay, fair enough. In terms of kind of going back to that natural rate, so I imagine the natural rate will take into account inflation, whatever that inflation may be. I mean, it just has to, right? In terms of the equation.
Yeah, absolutely. So anyone with skin in the game, risk return assessment, let's say I'm borrowing money from you. You're going to make an assessment about the risk of me not paying the money back. So you'll charge me a little bit higher interest rate if you're nervous about that. You'll charge me a higher interest rate, a term premium, if I want to borrow it for 10 years rather than 1 year. And then you will charge me more interest based on what you think the inflation rate will be over the next 10 years to offset the debasement of the money that I will be paying you back.
Okay, fair enough. And so You then also have cultural differences, I believe, that are shaping what the natural rate is all over the world. Is that correct?
Yeah.
Like America versus Japan versus China?
Yeah, different savings rates should lead to different natural rates of interest.
Okay, and then just kind of following up, there's an article the other day. I guess right now in Russia the rates are around 21%, which is here when you look at it in America, that's pretty damn high. But to your most recent statement, Paul, there's some assessment of the risk, some assessment of inflation, some assessment of all these other elements, and so that 21% in Russia might be equal to the 5% here, without making
Yeah,
that statement,
absolutely.
but it may be. Absolutely.
Yeah, no, absolutely. It all depends on the confidence that you have in the currency of that sovereign. And if you think that they're going to increase the money supply to pay you back, then you're going to demand a higher interest rate.
Fair enough. Okay. And so now let's go back to COVID. COVID, there were three bailouts here. Right away, I'll call them a bailout, but the government asked us to stay at home, and then they sent out a check. That was them cutting down the economy overnight. It's deflationary by nature because nobody's consuming, or they're consuming less. You advocate, I believe, for a light touch generally by government. What is the right, what can one do in that, or what should government, in your opinion, do in those instances? Like how do, yeah, go ahead.
Yeah, so listen, it's not easy, right? I mean, COVID was
Yes.
such a shock. And so, to a large extent, governments were flying by the seat of their pants. They didn't know what to do. We hadn't really experienced anything like this in the modern era. I guess you had the Spanish flu back in 1919. So, as I said earlier, I don't think it was a good idea to send stimulus checks if you were going to shut down the economy. I understand why they shut down the economy. I'm not saying it was right or wrong. I honestly believe people were doing what they thought was best. And it was scary. It was a scary time. But I think it was a mistake to encourage everybody to go shopping after you'd shut down the economy. And of course it would lead to inflation. But it doesn't mean that if you shut down the economy and people are sent home, that you shouldn't be sending them checks. People should be receiving unemployment checks or whatever benefits. This is how the system is devised, to help people out during difficult times. But the government tried to stimulate the economy, and I don't think the government should be trying to stimulate the economy at any time, either through monetary policy or fiscal policy. I think people are the best decision makers about what to do with their own hard-earned capital, when to spend it, how much to spend, what price. Governments, remember, Joe, that governments don't produce any capital. Any capital they have comes from the private sector, and they can access that capital in one of three ways. The direct way, of course, is through taxation. They can borrow capital, which then puts the burden on the next generation. And they can print money. Whenever they print money, it extracts capital from the rest of money already in existence. So in order for the government to stimulate the economy, if you're not willing to spend your capital, they will extract your capital from you and give it to somebody else who will spend your capital for you to stimulate the economy. And I just think it's morally wrong. I understand their motives. Their motives are well-intended. They all believe that this is good for the economy. And by taking your capital from you and giving it to others to spend, to consume, that don't worry, the benefits of all that consumer spending is going to trickle down to you. So you're going to more than offset, be more than compensated for the capital that we took from you, either through inflation or through taxation. But it doesn't trickle down. And when you encourage, the more capital that they extract from the private sector to redistribute to people to consume, the less capital that is saved and invested to produce more stuff in the future. So productivity growth in the US, generally, not every decade, but generally has been on a declining path. And it had been on that path because we've been moving further and further from the natural rate of interest, which should be here, and we've been going closer and closer. The neutral rate keeps going down because there's so much more and more debt that needs to be serviced. You need lower and lower interest rates to keep the spending going.
Yeah, but, in terms of the government, in the job, there's two key roles of the Federal Reserve, right? One of the key roles is to keep inflation in a range. And then the other one is full employment. And let's focus on the inflation one for a minute, because when you do get deflationary, kind of going all the way to the beginning of our conversation, if you're in a deflationary cycle like you got into during the Great Depression, for instance, then items don't just get a little cheaper, they get a lot cheaper. And then you get into this perpetual cycle where you're essentially saying, well, I'll just wait to buy that TV. I'll just wait longer. I'll just wait longer. I'll just wait longer. And so something, the thought is like, what prompts us to spend? And then again, going back to the Great Depression, where we had become protectionist, amongst a bunch of other kind of, I'll call them missteps. One of the things that conceptually got us out was spend, right? And that spend was on great works, which put people to work and built, infrastructure and, the whole bit. So I mean, aren't there points, and I think maybe you stated there was a point even during COVID of like, hey, unemployment checks, that's important. Social welfare, that's important.
Absolutely.
So aren't there points of where the government should show up for its
Well,
constituents?
for things like that, absolutely. I don't think they should be trying to stimulate. It's just such a slippery slope. And we're on a terrible path right now, in my opinion, in terms of government involvement in trying to drive the economy rather than have people, businesses drive the economy. But let me go back to the Great Depression and a couple of points you just made. So good deflation results from increased productivity in the economy through saving and investment and competition competing away excess profitability. Right? That's good deflation, and prices will fall a couple of % per year. Bad deflation, like you had in the early part of the Great Depression, is when the money supply falls. We should never have a falling money supply. That's really bad. And I think central banks have learned their lesson in that regard. But that was only in the early part of the Depression. In fact, you had quite high inflation after 1933, I think it was, and sustained right up until 1937. And then you had the Roosevelt Depression, I think they called it, in 1937, which was caused by a combination of monetary and fiscal policy because they were worried about all the bank reserves that were building up in the system. And for your listeners, if they want to read a great book on this, I'm about halfway through it, False Dawn by George Selgin. And he talks specifically about the impact of the New Deal or New Deals on the economy and whether they contributed to recovery or not. Now, in terms of your comment about buying a new TV, if there's deflation. Now, I talk about this specifically in my book. So central banks will tell you that, even if there's zero inflation, people will stop spending. Even worse if there's 2% deflation. So now think about a TV for a second. So TV costs $300 and there's 2% deflation. So your choice is to buy that TV today for $300 or wait a year and save yourself $6 and buy it for $294. You're not going to wait.
Yeah, Yeah, I agree.
You
And I
know?
don't think it's about that. I think it's really about runaway in either direction. Right? You go to
Correct. Correct.
Argentina where every hour they're price tagging the food in their grocery because it's going up. And that's an example. You got to run in with your paycheck, buy everything you need and exchange your money, which is worthless, for goods, which is worth something better. And then the
Yeah.
flip of that is, if you could wait a few days and, maybe not eat lunch or dinner and have a little extra money. So I'm talking more about those kind of elements. And
Yeah.
I
No,
think
that,
that's
that
where,
absolutely.
yeah,
Absolutely.
yeah,
Well,
yeah, yeah.
just as a side note, during the hyperinflation in Germany in 1923,
That's right, Weimar Republic. Yeah.
it was so bad that companies were paying their employees 3 times a day. So you get your first paycheck in the morning and you go out and spend it as quickly as you could, because if you waited till the end of the day, your paycheck would have been worthless. That's how high the inflation was.
Yeah. No, it's amazing. And you go back, I think, right, it's very scary. We're lucky to be in an area where the money supply, well, currency seems stable enough, right? You go all the way, I think Mongols were the first ones who did it, where all of a sudden it's like, oh, we got a war. Well, we could just print lots of money. And then all of a sudden it's like, oh, wait, we have so much money. Let's buy horses. All of a sudden horses were incredibly expensive because there's a limited amount of horses. Right? And that's your problem with
Well,
inflation. Deflation goes the other way.
well,
In some
exactly,
ways.
Joe. And
Yeah.
that is why my book is called Capital Offence, subtitle, Why Some Benefit at Your Expense. That not enough policymakers differentiate between money and capital. They're two different things. Capital is what you produce, either a good or a service, but it's not a barter economy. We don't exchange our capital like directly like coconut for a fish.
That's right.
We sell our capital, we store it up in money. And so that money that we have effectively represents the capital that we produced, that we created through our hard work, through our savings. And any capital in a free market capitalist system, any capital that you have, any wealth, is supposed to be a reflection of the wealth that you've created and that somebody else out there is benefiting from, because you fairly exchanged the capital that you both created. You're not supposed to be benefiting at somebody else's expense. But this is what's happening today. I mean, there's still a lot of good things going on, but more
Yeah.
and more people are benefiting at somebody else's expense, and that's why people are getting angry.
Yeah, no, fair enough, right? It's a standard medium, is what should really be out there. So one of the, we're in a world where government's playing an increasingly active role, propping up markets, directing capital. You outline a number of fixes. I'm gonna name them: lighter touch with less regulation of government, lower taxes, fewer bailouts, more free trade, but still strong investment in security. When I say security, I don't mean financial securities. I mean actual literal security, like armies, police, law and order, and a welfare safety net. So with that in mind, and it sounds great. A complexity. I'm going to highlight a complexity. China. We have some amount of free trade. We'll see where it goes. Some amount of tariff trade with China. And China's been accused over and over again of subsidizing key industries to essentially squeeze out competition. You have over 1 billion people. You go and you create. I don't know. I'll pick up the sneakers. I don't know why I came up with that one. The sneaker industry. You go there. Mm-hmm. You create a whole area. They did it with electric cars. That's probably a better example. So electric cars, they say, okay, we're going to create a region. This region is going to be for building and developing electric cars. Everybody who builds electric cars has to come here. If you come here, you get tax abatements, subsidies, et cetera, et cetera. And then what happens is you also build this incredible expertise because everybody's right next to each other. And so that's really beneficial in building out and building up true expertise in an area. We actually talk about that in the commentary too, but we use Ireland and pharmaceuticals instead of electric cars. But let's just stick with China for a minute. Mm-hmm. What should a government do about something like that? I'll just claim that a country's kind of cheating. How should the government help its citizens in counteracting that outside of policy response and maybe a heavier government touch?
Yeah, so trade needs to be fair. and you need to be able to trust your trade partners. And so that's not fair. If the government is subsidizing industries and then dumping those products in the U.S. and other Western economies. Now, there are some economists who would say that if the government is willing to take their taxpayers' capital to subsidize production of cheap electric cars and then sell them to us, well, why shouldn't we let them? Right. Well, one of the issues is that it could eliminate electric vehicle production in America, and then we lose all that expertise, and it's even more concerning for areas of strategic importance and national defense and stuff like that. So I get that, and there should be a response. And as well with China, they've been abusing intellectual property rights for years, and everybody's known it. But people tended to turn a blind eye because everybody wanted access to the China market.
Right.
And so when you don't deal with things early on, the consequences just escalate over time. And it's not just with respect to these things, it's with respect to anything. It's this short term, turn a blind eye, stick your head in the sand, don't make the tough but necessary decisions, and hope that something down the road will come out, of left field or whatever and save the day. Well, it typically doesn't, and it's just denial, hopium, whatever you want to call it. And it applies to so many things in terms of what's going on in the economy. Tough decisions need to be made. Social Security, the latest estimate I saw in 2033 is going to be insolvent.
Right. So it's the proverbial kicking the can down the road problem.
Something needs to be done. And we don't want to demonize people. We don't want to demonize anybody. Let's all take a realistic look at this and what can we all do together? Not just try and punish one part of the population at the expense of the other or whatever. And just having real honest conversations. And just in terms of where the economy is going and our system and the unfairness of it and the wealth disparity that has resulted from this. I believe that, I really do believe, I have great faith in people. I think people are so smart. The average person is so smart, particularly when it comes to their own skin in a game and how they're going to spend their capital. But if we're able to educate people with respect to what's going on, that you can't get something for nothing, these fallacious fairy tale economic doctrines, and that these are the steps that we need to take in order to fix the system. And as long as people believe that we're all in this together, that we're all going to be making some sort of sacrifice, then people will be willing to do it. But people won't be willing to do it if they think they're the only ones who are going to suffer, and that's the elite who are going to make out like bandits. No,
yeah, I think it's fair. I think it's a hard in today's world. It's hard messaging, but maybe that's a different podcast. So your book ends on a note that ordinary people need to understand how the system works so they can demand better policy. If you could leave the listeners of this podcast with one takeaway for protecting themselves and their families in this system, what would it be?
So, no, I'm not allowed to give financial advice, you know that.
That's right.
But
right, no recommendations. No. Yeah.
No. Be realistic. In terms of your portfolio, diversification in high quality assets. Either equities, corporate bonds, maybe some hard assets, being careful with valuation, of course.
Yeah.
But with high quality, even if you overpay within reason, over time, that high quality can often get you on side. but there are no guarantees here, right? And I mean, that's what I would do and that's what I do. I'm very conservatively invested, balanced. But I think more importantly is what we were just talking about, and it's education, informing yourself with respect to what's going on. And so you're not blindsided, and you don't fall prey to all of these, everything is fixed, mission accomplished. It's the roaring 20s. That's what, you were hearing that 3 years ago. We're going at a new roaring 20s, and everybody's hopeful, because if these things happen, a lot of people are going to make a lot of money. And just be careful. Just be careful. But stay invested, keep moving forward, keep learning, and I think good things are going to happen.
Well, Paul, thank you for that. Thank you for the conversation today. Everybody go out and buy Capital Offence. It's a good book, so thank you for putting that one out. And we'll speak soon.
Well, thanks so much, Joe. It was a real pleasure.
Have a good day.
Bye-bye.
If you like what we do, rate and review the show on Apple Podcasts or Spotify. Every positive review helps new listeners find the show. Send us the debate topic you are most interested in by emailing us at podcast@fountainheadam.com. Thank you to Fedi Smooney for production, Sarah Mance for marketing, and Dalton Morrow for research. I am your host, Joe Halpern, looking forward to our next investment war.
Fountainhead sponsors the podcast to further education and critical thinking about the factors that affect markets and investing, and the podcast does not provide investment advice. Investment advice is offered only to clients of Fountainhead who have entered into an advisory agreement and with whom Fountainhead has identified individual objectives, risk tolerance, and other investment needs.